Welcome to Chit Chat Stocks, a podcast where we help you discover your next great investment. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. We had a substitute in last week. We had an episode with John Rotanti, and we talked about what it takes to make a multi-bagger, what the formula is, what's some of the most common ways are to find a multi-bagger in the early days. But today we've got a bit of a different discussion. It's still earnings season, and we didn't really get a chance to talk about the cloud providers since you were gone last week, Brett. So I want to talk about the cloud providers. I also want to talk about the remittance world. Figma went public at I'll just say it now, a ludicrous valuation. So we can talk about that. Coupang earnings, OpenAI's private market valuation, Nintendo earnings, the list goes on and on. But before we get to all those topics, I want to remind listeners, please, 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 please give us a review if you like this show. It really helps us out. It should only take a few seconds of your time, and it's the best way to help us grow. So really appreciate it if you do. We also have a newsletter that's free that has all accompanying charts that we might have in our notes or anything we might talk about. So check all that out. It's Chit Chat Stocks Substack. You should be able to find it pretty easily. Brett, how are you? How's earnings season treating your portfolio?
Glad to be back. Yes, lots of earnings this week, lots of listeners requesting. And again, we've had a couple of new listeners join the show. So if you like the show, you're listening on Apple, the best way to do it, just give us a nice review. It takes 5 seconds. But yes, tons of earnings. Coupang, Remitly, Portillo's. A lot of people wanted to talk about that one. That's kind of the ugly one in my portfolio. I had on our newsletter, and I think a comprehensive write up on the quarter, which I'd recommend if anyone that's interested in that, go check that out. That has my full thoughts. We'll definitely talk about them because they are, at least for my portfolio, at a bit of a crossroads. And what else do we got? Well, I wanted to maybe include some of the meme stocks, Open Door, maybe just for titling purposes, that did not work out as some of the pumpers on old FinTwit maybe hoped. Ryan, where do you want to start?
Well, maybe just for a second on the meme stocks, there was something that was brought to light here, which is the real bummer with meme stocks is that they still have to report earnings, that there's a business
Yeah.
there that it's just,
Worst part of the quarter. We got to know
yeah,
what they're actually doing.
yeah, just so humbling. And if they just could avoid reporting earnings, that'd be great. Now, I want to talk about the cloud race. There are, it appears that AWS is falling behind. I'm going to go through some of the data. Why don't we start there? So, Amazon and Microsoft reported earnings last week. Google reported, I believe, the week before. Those are kind of the big three hyperscalers, big three cloud providers. Meta also has their own cloud that they use internally, but they're not really offering cloud infrastructure or compute services to other companies. Brett's sharing a chart here just showing the growth rates of AWS, Microsoft Azure, and Google Cloud. Microsoft Azure is growing the quickest. Google Cloud is growing the second quickest, and AWS is growing the slowest, but AWS is also the largest. So there was Google reported first, and they saw a big acceleration in Google Cloud revenue growth. It jumped from 28% growth to 32% growth quarter over quarter. And it was one of their biggest, when you look at Google Cloud ARR, like net growth in Google Cloud ARR, it was the biggest quarter they'd ever seen. Same with Azure. They reported a huge jump. But AWS was a little underwhelming. They reported just like a marginal acceleration relative to the last quarter. If you look at it in isolation, you just looked at AWS's numbers, you didn't know anything about Azure or Google Cloud, you'd think it was a pretty good quarter. Revenue growth did technically accelerate. It surpassed expectations, but relative to competitors, it wasn't great. And an analyst, I believe that Doug guy from JP Morgan, who seems to be on every big tech call.
I'm not aware of the Doug guy, but I assume he's probably one of the lead analysts at JP Morgan.
Yeah, he has pretty good questions usually. Yeah, I think it's Doug Anmuth. Anyway, he's JP Morgan analyst. He's on all the calls. So he basically asked Jassy, like, why are you like, it seems like the competitors are growing faster. Like, why? And Jassy gave sort of this underwhelming response, but really it was like kind of a word salad that was hard to follow. Like at first he basically said like, well, it's important to remember that we're bigger. So yes, on a percentage basis, that makes sense. They're growing a little bit slower because they're already so big. But then he kind of went into this like abstract answer about like how this is just a point in time. Like we're really just at a point in time. It was really hard to follow. And as he was talking, Amazon shaved off $150 billion in market cap from that response.
Just
That
a
might,
few percentage points for them,
yeah,
but still, that does seem large.
it was probably one of the most costly responses in conference call history. But anyway, that was kind of hilarious. But so it's fair. They are the biggest. I think they are almost 50% larger, maybe a little larger than, a little higher than 50% larger than Azure. But when we look at things on a nominal basis, because you can kind of parse this out. Like Microsoft is a bit opaque in what they say for Azure. So they give revenue growth rates for Azure, but they don't give nominal figures, which this whole thing is just weird to me. I don't know why they don't just break it out. It's annoying, but whatever. And then they'll give like commentary on conference calls. So they said hit $75 billion in Azure revenue for
Yeah,
the
you are right about Microsoft. For some reason, they want as many people listening to their boring conference calls as possible. They don't do the guide written, right? And they force you to get the Azure numbers there. Just tell us the numbers, guys. It's so frustrating.
Yeah, it is. But we can kind of make out some of the nominal growth. So Google Cloud added $1.4 billion in new revenue this quarter.
Quarter over quarter.
Yes, quarter over quarter. That was a huge acceleration for them. So 1.4 billion Google Cloud. AWS added 1.6 billion. So technically AWS is still growing faster than Google Cloud on a nominal basis, but not by a whole lot. And this was certainly a step in the right direction for Google Cloud this quarter. Azure, on the other hand, they give out Microsoft Cloud revenue, which is basically just their whole business, like almost. It includes like cloud services, like Office products, so Microsoft 365 products, all that stuff. So it's way more than just Azure, but it's about, I believe, roughly 45% of that line item that they report is Azure. So if we assume that the growth was in line and was primarily Azure, you're looking at basically $2.5 billion added in quarterly revenue this quarter for Azure. So just to sum it up, I know I'm going long on the numbers, but at Google Cloud, great quarter, step in the right direction, starting to look a little more competitive in the cloud world, 1.4 billion added. AWS slowing down, 1.6 billion added. Azure had probably the best quarter they've ever had and added $2.5 billion. And this is all sequential. The question here is so yes, I think AWS is losing share. Why are they losing share? And is it just them falling behind when it comes to AI workloads? Because that to me would be concerning. Would be if all these AI workloads are just going to Google Cloud and Azure, and it's not really falling on AWS. But some industry research showed that most of Azure's growth this quarter still just came from legacy cloud migrations and non-AI cloud workloads. So they talked about, there's a quote from Satya Nadella in the conference call. He says, "We continue to lead the AI infrastructure wave and took share every quarter this year." But really, the bulk of growth here was still just from legacy cloud migration. So I guess
Wait, you're saying Azure is legacy cloud migrations?
that was the bulk of their growth. Yes, Azure.
Yeah.
I
I
would
was
have
gonna
thought it was
say,
just AI workloads.
I would revise Nadella's quote. We continue to lead the AI infrastructure wave and took share every quarter this year. We continue to have a relationship with OpenAI. I think that's their whole revenue acceleration, correct?
Probably.
Yeah. Google Cloud
Probably.
seems to have the startup wins in the AI space. They, from what I've read, have the best AI infrastructure. Amazon doesn't have the OpenAI relationship or the best AI infrastructure for startups from a cost perspective. Google Cloud seems to be in the lead there at the moment. But one thing that could be their saving grace is Anthropic. They have a huge relationship with AWS. That's the OpenAI's partner, and their revenue is growing. I think in June their ARR was $4 billion, and now it's at $5 billion. So it's growing at an insane rate. So that could help, be the OpenAI for AWS. But besides that, yeah, you should definitely be concerned if your whole thesis on Amazon is AWS, because I see no reason why Google Cloud doesn't keep taking share from them. Microsoft might be a different story because they, I think, are reliant on OpenAI. But besides that, yeah.
My
Now,
yeah.
Amazon itself, is a diversified business, but AWS, have a little less confidence in at the moment, and I would almost want to just have it reliant on the North America e-commerce business.
I think people are overestimating or overthinking the slowdown here for AWS. Like, this might have just been a quarter where there was some market share taken, and now it's been a couple quarters in a row, I think, where Azure's grown share, but AWS is still the largest provider, and it feels like every business you hear about still runs their core infrastructure on AWS in some way. So I yes, competitively, it might not be in the same position it was 3 or 4 years ago, but it's still a great business and in a good position. And I think they're doing wonders on the e-commerce business. So I really think Amazon's in a good position. Anyways, we weren't able to talk about that last week. I want to talk about a fun topic, maybe Bubble Watch. Figma
Figma?
IPO. Are you buying?
No, I still can't figure out what Figma does. They talk about workloads. They just keep saying cloud sharing, design sharing. I still don't know what it even is. But good luck to the investors. And hey, it seems like any shareholders before the IPO are going to be quite wealthy.
Yeah, let's do a little history here for Figma. 2022, I believe, was when Adobe announced their acquisition of Figma, which ended up not going through. That was for $20 billion. Figma at the time had like $500 million in revenue. Now it has 850 million, I believe, 820 million in sales. So it's grown quite a bit since. They were pricing, or Figma priced its IPO at what would equate to a market cap of $19.8 billion. So basically in line with what Adobe was going to acquire them at. On day one, the stock surged, helping them peak at a market cap of $67.6 billion.
I heard it
I,
was a 5% float or something like that, and insanely thinly traded. Most of it wasn't available.
yeah, I assume that's right. I mean, I'm pretty sure they've shaved off 35 billion already from the high. So
Wow.
it's not sustained the valuation, but you asked me, I think a month ago, maybe, what I thought Figma would trade at, and I believe I said
Y-
40 billion. Day one, it surpassed my estimates. And
Hey,
to be clear,
today, 38 billion. You're right on track.
yeah, to be clear, I do not think that is a fair valuation. I just think that's how insane the IPO markets are. That let's use that peak valuation for a second. $67 billion market cap for Figma. That is a price to sales of 82. That is basically half of Adobe's market cap. Adobe generates 27 times more sales than Figma.
Yeah.
This is
But compared to
this is the
Palantir, it's
time.
cheap. Compared to Palantir.
Sure,
Yeah.
everything's cheap.
Yeah, true.
This is the time, if you are a private company, to go public. If you've thought about it, if it's on your roadmap or radar for the next 3, 5 years, just make it happen because you will get a lot more money today, I'm guessing, than in 3 to 5 years. But I digress. Anyway, who would you like to see take advantage of this IPO market right now?
Huddle, because that would materially affect my wealth. So yeah, that's about it. Who is the CEO of Huddle? Whoever they are. If you are somehow listening to this, please go public. But what I will say on Figma, maybe heading into the lockup period, it could be fun to have long Adobe, short Figma. It doesn't seem like this valuation makes sense whatsoever, but people say that Figma is a great business. This is not a market I know much about, so hey, I'm not buying it at 82 times sales or even today, what, 40 times sales? Probably not going to work unless they 10x their revenue in 5 years, and I doubt it will.
I will say I have been buying Adobe shares here.
Hey,
It's
all right.
becoming one of the largest holdings in my portfolio. 16 times operating income, I think, as of today, maybe 16 and a half. It yeah, obviously relative to Figma, it seems great.
Seems cheap. Yeah, I'm seeing that the stock is keeps falling.
Yeah, for some reason, software is down today across the board, but
Well, everyone
anyway,
switch. Every contract it will switch to Palantir.
I saw that Palantir is worth more than Salesforce and Adobe combined.
Yeah, it's worth twice Salesforce and has 10% of the revenue. I actually just did a Motley Fool article on that, so I had the numbers in front of me. Yeah, it's a great business, but pretty insanely valued. And full disclosure, I am short a couple shares.
That I'm gonna go out on a limb and say it's the most we've talked about this before, but I think it is the most insane valuation of all time. Purely just I know that I think Yahoo or something hit like 200 times sales or something really high, but and maybe I would just need to give more credit to the dot-com bubble, but I wasn't around or wasn't investing then.
It's like old sports arguments. You weren't around for Maradona, so you
Yeah,
can't appreciate him.
but this is for sure in the last 15 years the most absurd valuation. Not I mean, I guess you can there's some subjectivity there because you can say like Nikola was absurd because there was no revenue, but in this case, the size of the valuation is the insane part to me.
Yep, 22nd largest market cap in the world.
We're starting to talk about some real numbers there, Brett. And
Yeah, that's someone. I think the average price target for like the Wall Street price target is 150, which is only less than a 20% drop from here. And I think I heard Dan Ives say that they're going to a trillion. I I'd like to see it happen. It could be fun, but a lot of people are going to get caught up into it, and it's just not going to end well. Don't know how
imagine
far it's going to go, but it won't end well.
imagine having that bold of a take that this company's going to $1 trillion and your returns are still like
Yeah, it's a
10%
double, probably a
probably
double. Yeah,
annually. Yeah. It's like
yeah,
you're going to get a double over 5 years. Okay. I think there's some lower risk places that you could potentially do that.
yeah. That's true. That's true.
What else do we want to talk about here, Brett? Do we
A lot of people wanted to talk Portillo's. Maybe we knock down the bad news first, and then we hit some fun ones that some companies that were doing well. Although Portillo's quarter wasn't that bad, but a lot of people did want me to discuss it. I guess just to sum up the quarter, I'm going through the update I did on the Chit Chat Stocks newsletter right now. Essentially, they had just under 1% comp sales growth, while they are estimating this year that, and we can actually they pinpoint it for us, commodity inflation is going to be 3 to 5%, and labor inflation is going to be 3 to 4%. So their comp sales are growing slower than their inflationary input costs, and that's going to compress their ability to generate a restaurant level operating profit. They actually didn't reduce their same-store restaurant sales target for the full fiscal year. It's still 1% to 3%. I think they said they're probably leaning towards 1%, but they're still within that range. The thing is, and what caused the stock to drop 20% is the fact that their revenue growth guide went from 10% to 12% down to 5% to 7%. And the majority, or really the reason here, was that their new locations in Texas are not performing well so far. I don't know if I want to read this full quote from the conference call, but it there's skepticism on the ability to scale the brand nationally. And on the one hand, I get it. Texas was what their biggest push, and it doesn't seem to be going too well so far. Although 2 years ago, when they opened their first one, it had like an 11 million average unit volume. You can definitely have that concern, but I think what management is saying, and I think I agree with them to a point, is that initially they over marketed when they were in Dallas, and that caused them to subsequently undermarket to not try to have the rush at opening. And this is something they can easily fix, because if they were under marketing, they can just get back to doing normal marketing for the new locations, and they can solve the traffic issues. They would also probably argue that, and I did talk about this on the conference call, that Portillo's locations have performed well financially in Arizona for a decade, and that is a very different market from Chicago. So they have proven that they can work in markets outside of the Midwest. They're also doing well in Florida and other Midwestern states. And they, 3 out of the 4 points here, that restaurant openings have been delayed more to the back half of this year, which is partly affecting that revenue growth. And then I think lastly, they would say that their cash on cash returns and restaurant level EBITDA margins, which I think generally um, coincide with what restaurant level cash flow is going to be, they remain strong. Well, I get some of that, and I'm still holding shares. I didn't buy or sell any this week. But the flip side is they've worked really hard, especially with the activists, the new board of directors, the new executives that have joined, about adding kiosk ordering, speeding up the drive-through. They launched the loyalty program, which does have 2 million members now, but hasn't moved the needle on comp store sales growth. I look at the valuation here, and we're at an EV to EBITDA of, I think, 14. There's a lot of debt on the balance sheet relative to the market cap now. So if comp store sales get to that 1, 2, 3, 4% level, especially because right now a lot of restaurants, Chipotle, Starbucks, I know not all of them, some of the ones that are more affordable, like a McDonald's or Domino's, are doing fine. But Chipotle's comp stores sales were much worse than this. Starbucks is still struggling. Others that I'm forgetting right now are still struggling. If Portillo's can get to 1, 2, 3, 4%, I think the stock is still a 10 bagger. So I don't want to get rid of that yet, but I'm feeling a little bit like it's a boy who cried wolf situation with management. They keep saying, all right, the things we're doing, we're going to just do the easy stuff. Excuse me. And eventually the comp store sales will show up and will improve there, but it hasn't worked yet. And to sum it up, I think my plan is to give them a couple more quarters. If they can turn things around, I'll keep holding, but I'm not talking the stock price, I'm talking the business. But if we still get comp store sales at 0% or well below inflation, yeah, was wrong about the idea, and it'd be time to sell.
There has there's been a slowdown across the board for fast food and fast casual restaurants. Like you said, Chipotle reported some terrible comps relative to their history, and there are companies on the value, like lower down the value spectrum, maybe it's higher up, whatever, just the more value providers like McDonald's and Taco Bell,
And
which saw
Domino's.
and Domino's, which saw pretty good comps. But a lot of the other ones, you look at like a Popeyes, Burger King even was a little slow. I was looking at the comp sales across sort of the restaurant space this morning, and they weren't great. Like it's maybe 1% flat, even negative comps. And you actually saw this if you read the McDonald's conference call. They talked about basically they are seeing strong volumes because they're leaning more and more into value. They're leaning away from like the higher ticket items. They want to try to get like the lower end consumers back in the stores.
And they're
And
capturing the trade down. I read that as
right,
well.
right. Whereas that's just not Portillo's market, really. I wouldn't say that they're seen as like total value.
No, it's more of a competition with the Chipotle Sweet Greens, Chick-fil-A's, Cavas of the world, I would say.
Yeah.
It's about that price point, 10 to 15 bucks.
Price point, yes. Diet choices, probably not what people are
Yeah,
debating
it's
in their
true.
head, but
That's true.
yeah. No, I think you've got probably a good approach there and
I g
wait and see.
Last thing I'll mention, they do have activists there. They brought a bunch of people onto the board of directors. That could be part of the catalyst here. I wouldn't be surprised if there's a management change. I also wouldn't be surprised if they keep them. It is a tough operating environment. It Look, the business is still generating tons of operating cash flow. They can slow down new restaurant openings if they're worried about cash flow concerns with the expansion. And that's fine. I mean, it's obviously not great, but they can do that. Like the core business is still highly profitable. And I look at them, market cap $500 million, EV probably billion ish, PE 16, EV to EBITDA lower than that. They're posting positive comp store sales. On the other hand, and I should mention, still under 100 restaurants. Or you can buy Chipotle, 4,000 restaurants, PE of 40, negative comp store sales. I think there is a good risk reward with this stock, and just because I think it's down about 40% since I bought it, I don't know if the thesis is entirely broken, but I'm not surprised that the stock's reacting as it is. And it's why I didn't make it a huge position. It was, I think, 5, 6, maybe 7% at cost.
Let's talk about a stock with a much better quarter, Remitly. This is my third largest
Yeah,
holding.
this is the one where I'm actually making money.
Let's pat ourselves on the back here.
Yeah.
This might have been, I would say, probably going into this quarter, this was the stock I was most excited to read the earnings report of. It just felt like it was finally in a situation where it was just had gotten very mispriced. And to kind of go through what had happened, there has been sort of a swirl of negative headlines around Remitly that have been hurting the stock. So first, there has been this, I don't want to say prevalence of stable coins because I don't think it's really being used that much in remittances, but this
A lot of talk, a lot of chatter.
fascination with stable coins from investors in that people are going to use stable coins as a form of money transfers and it's going to hurt the remittance providers. We haven't seen that yet. I don't think there's no data that I've seen that shows that. And you see the digital remittance providers just continue to grow volume year after year. So yeah, it really doesn't seem to be the case. The other thing I'll mention is like right now on Remitly, let's say you are a Mexican American citizen and you're sending money back to your family or your grandma or whatever, you can like send money back home for your grandma to pick up in pesos at the Walmex or the Walmart in Mexico
Or
and
Oxo, yeah.
whatever. And it's just so easy for the recipient. I think it's a lot harder to be like, look, open up your stablecoin wallet. I'm going to send it. I'm going to send you stablecoin USDC. I want you to off ramp it to your bank account, which you probably don't even have, or somehow convert this back to pesos. It's just a lot easier at the moment. So, and maybe there's long term, whatever. Maybe you think stablecoins are the future, but at the moment, Remitly is still thriving on that type of transaction that I just described. The second one here is this quarter, we saw a crackdown from the US presidential administration, and the US is Remitly's biggest send market. And there was some cautiousness. And even if you actually looked at the World Bank data, remittances from US to Mexico declined year over year.
I
And
think, yeah, 16% in June. Yeah.
really, I didn't think it was that stark, but oh, just in June. Okay. Yeah. So that was putting a ton of pressure on the stock. And the concern here was that revenue growth was going to be way less than people expected because send volumes were going to fall off a cliff and less people were going to send money back home because they were just a lot of people weren't showing up to work. They were afraid of whatever. Western Union then reported, I think, a week before Remitly, and they said, yeah, we're seeing this. Like, we're seeing this play out. Our volumes are being impacted by this. And then there was also the tax, the remittance tax that was introduced that doesn't affect Remitly in any way. It's actually definitely a net positive for them because if you were sending money with physical cash, now you'll be taxed. And if you send it digitally, you won't. So it just increases more volume to digital remittances. Anyway, all that stuff was going on, and Remitly grew send volume 40% this quarter, basically close to its fastest rate in the last 3 years.
Yeah, was that an acceleration? I think so.
It was 41% last quarter.
Okay.
I've got a chart pulled up here, Brett. Maybe you can share this. This is a real-time example real world example of the innovator's dilemma in practice right now. Remitly has just about surpassed Western Union in its North America. So this is North America revenue. And keep in mind, this is revenue. So Remitly has a lower take rate than Western Union, and I believe in most corridors. So send volume, I would imagine Remitly's already surpassed Western Union, but the stock jumped like 15% today. The volumes continue to grow. More people, this is a great example of like the market shrank and Remitly still grew because they're stealing share. The send volume from Mexico or from the US to Mexico specifically, I think grew like 34% in a time where send volume across the board was declining from Mexico from US to the Mexico. So it just goes to show how nice it is to have the market share taker in this case. And I continue to remain extremely optimistic about Remitly here. And I was running through some numbers.
Yeah. Hey, don't get optimistic, Ryan. Yeah, the stock looks cheap.
Let me paint a picture. 15% revenue growth for the next 5 years,
That's fair.
which seems very doable. They're growing like 35% right now. Operating margin gets up to 15%, which I think is like what their EBITDA margins are at right now.
I think that's also fair. Yeah.
You'd be looking at, I think they would be generating, I want to get this, they would be trading at 6 times their 2029 operating income. And I think
Yeah.
both those assumptions are very reasonable. That to me is one of the cheapest growth stocks out there today that actually has like a clear path to operating leverage.
Right. And I don't know if you're including enterprise value, but they're generating a lot of cash now. I want to say they started a buyback. I'm reading a lot of earnings calls, so it's kind of blending together. But they may have started a buyback. EV down to 3 billion still. Yeah, pretty cheap. I mean, they up the revenue guy. I think it should have been much higher today. Maybe I can even hit on some of the other things they're doing from a technology standpoint. Of course, they mention AI. That's really just customer support stuff. I kind of would ignore that when talking about their agentic AI, although it could be helpful. But the two things: one, they're allowing stable coins to be onboarded to Remitly. This is going to be launched officially in September, but they, I guess, wanted to announce it and talk about it with the quarterly call so analysts could ask questions. You're essentially going to be able to fund your account with stable coins, and again, it doesn't reduce fees to zero because if you want to go to your local currency, you still have to convert from the stable coin, just as it would be like a US dollar, to that currency. So I think what's weird is that people said stablecoins are going to kill these platforms, and I think they're going to actually help them, especially the digitally native ones such as Remitly or Wise or what have you, especially if it can reduce their cost even further. They actually said they're using it for, I think, off hours or some sort of ways to manage their balance sheet and manage transfers so they can hold USDC on their balance sheet. It helps with transferring in between different countries. I don't know the exact details, but the second one is they're launching, I think it's called Remitly Flex and Remitly Wallet as a part of this new membership program they're launching for digitally native people that need to send, for example, like a rich tech person that has family back in Asia, something like that. The Remitly wallet will allow you to store money in various currencies, especially helpful for people that don't want to have foreign currency devaluation risk or stuff like that. They operate in hyperinflation environments. You can hold a variety of different currencies or what have you. And you could earn interest income eventually on this, I think. And they're also doing this thing that I think is interesting called send now, pay later. Not buy now, pay later, but send now, pay later, where if you're under a cash crunch, I don't know what the fees are going to look like, but you can almost get a little bit of a loan or you pay a fee, an extra fee to, the money arrives to the recipient, but you don't take it from your bank account still until a certain time. I think that's a nice little innovation as well. A lot of products coming down the pipe to especially expand this platform to be a personal finance app, and a lots to like because I think you can still make money on this core business, just taking market share going from probably about 3% today to 5 to 10%. You can make a ton of money in that, but then they also have all this other stuff coming down the pipe that could take them to the next level. I agree on you, Ryan. That 6x number, if they're valued at 20 times earnings, pretty reasonable figure for a company like that. You could see a 3, 4, 5x in the stock price within a couple of years. That's as your upside. That's what you're looking for.
Yeah. And this, I think this chart actually shows a lot of volume. So you mentioned the buybacks, or you mentioned the buybacks earlier in the that little monologue there. The and yes, you're right. They did. They repurchased $11 million worth of shares. Now, in the grand scheme of things, that isn't a lot. They have a $3 billion enterprise value. So if you annualize that, it'd be like 1% of their market cap being bought back in cash.
Not enterprise.
But
3.4 billion market cap. Not
yeah,
wouldn't want to use enterprise value, but similar. Similar.
but when you have a platform that is very focused on like they say they generate 6x on their like LTV to customer acquisition cost. So they are attracting users and earning a ton of money when they do. So they are plowing money into marketing, they're plowing money into R&D for these initiatives because they're getting a lot more businesses that are sending money through Remitly. They
I didn't
are
even mention the micro businesses. Made me think of ourselves.
yeah.
Micro business. That's how I define our podcast. I mean, we use Wise, but Remitly, there's definitely enough for two players here.
I think whenever you find a business where they are in full growth mode and then they are still like, okay, we got to buy back some stock. And they have a quarter like this where they just plow $11 million into the buyback out of nowhere. It's usually a pretty good signal that the people that know the business the best think the stock is quite cheap.
Is that the stock chart you're showing here, Ryan?
Yeah, this is quarterly buybacks.
Yeah, and we could see an acceleration. I think it's a great use of capital. They're very cash flow positive, especially because they use a lot of stock-based compensation for their compensation. They use a lot of stock for their compensation, and that's going to make cash flow a little bit higher. But you're going to have more cash piling up on the balance sheet that you can redeploy into buybacks.
Yes, and I'll give a quick shout out to Fiscal AI. You're able to pull those numbers up really quickly. Pulled the comp sales figures up for McDonald's and Taco Bell and KFC as well, and basically all the quick service restaurants. It's all there. It's got tons of data. And if you want a discount, which we've had a lot of people sign up and use this as their research terminal, check out fiscal.ai/chit chat. You'll get 15% off. Brett, where do you want to go next? Coupang. How about Airbnb? I think that's a little sexier than Coupang.
Yeah, another one that I do own that the stock's down today, but not too badly, I guess. Not too disappointed from when I bought it in April, but they had their report. They talked a lot on the call. If you want to read the earnings call, I can sum it up for you. AI, experiences and services, and the analysts keep wanting them to add hotels, and they say no. That's about it. So, no, we have more. There's more to actually discuss, but I don't know if you want to skip the call. They're still growing slightly slower than Booking Holdings, which is something to track. Ryan had a good chart on that from the Fiscal AI account earlier this week. They saw some solid green shoots in new markets. Brazil and Japan are growing quickly with their new marketing strategy and localization strategies, but right now it's not moving the needle because one of their biggest markets, North America, well, probably their biggest market, is growing at a low single digit rate in nights and seats booked. So that's the amount of just nights booked in North America, coupled with just slight ADR growth, which is their average daily rate. So you have kind of the inflation in occupancy costs. This is a headwind to their overall revenue growth. Overall revenue, I think, grew over 10%, but that would be, for North America, only 6%. That's why the stock's down today. I think, again, if we look at it holistically, though, the business keeps chugging along. They're plowing money into buybacks. They have a really optimal business model to plow money into buybacks. So the stock price, or excuse me, the shares outstanding are going to come down steadily in the years to come. I made a note to myself to look up the valuation, but I need to do that in real time with our friends at Fiscal AI. Platform is working much quicker, I will say. I think there was an update this week, but Ryan, maybe that's just my internet. Market cap is 80 billion, enterprise value is $7 billion, PE says 31, although I think the true figure for EV, okay, will be a little bit lower. It's not dirt cheap. I don't think I'll be buying here, but nothing to be concerned about. One quote from the call that I thought you could either have a glass half full or glass half empty on is, quote, "We've received significant interest from potential services and experiences hosts with more than 60,000 applications submitted since launch. While these new offerings will take time to scale, we're encouraged by the early results." So these are the new experiences and services such as tours or stuff you can get at your home on Airbnb, like a private chef or massages, photography stuff, what have you, whatever any person wants to do on a vacation. 60,000 applications seems good. It's not going to move the needle for a long time, but they're doing the right stuff. They talk a big talk because Chesky's kind of a showman. But I think this thing just keeps steadily growing. I'm not too concerned.
Yeah, the quarter seemed fine. It's a fairly predictable business, especially considering that Booking Holding reports right before them, so you usually have some sense of how they're going to do in terms of global travel. They are a little more levered to the US and North American markets, like Brett said, and I can't imagine that some of the anti-globalization rhetoric from our presidential administration has been super friendly to travel from the US. That's just to say, like,
Even inbound from like Canada or Europe to
I
US.
yeah, I
Yeah,
think people
yeah,
have
fair.
maybe, if they were debating between a trip to the US and a trip to another country, maybe right now they're choosing that other country just because I don't know. The
Yeah,
presidential
no one
administration
asked
hasn't been
about it
very
on yeah.
friendly.
Yeah, no one asked about it on the call, but that could definitely be an impact right now because the rest of their markets are growing faster, but North America is more saturated. They still toss out that thing like, oh, only 1 out of 10 people choose Airbnb for a trip in North America. We get to 2 out of 10 instead of a hotel, we will like double our market share, but they've said that for a few years now. So maybe the TAM in the United States is a little more limited than we think. They have to get more creative. We'll see.
The number one figure to track, and they don't explicitly state it, is just the active listings. They like active listings solves everything, I guess, for them, where if active listings grow, diversification of places to stay on the platform grows, gives people more options. It makes prices more competitive. It means more people are going to turn to Airbnb instead of the hotels. And kind of there's that virtuous cycle. Basically, it helps their network effect. But I don't think very highly of these other offerings, experiences, and services. Little anecdotal evidence here. I was looking for an experience. I
Oh, an experience, Ryan.
it sounded a little weird, but my girlfriend's birthday's coming up. I was like, I wonder if there's any local experiences we can do on Airbnb. And there was one that was interesting, but it was a couple hours away. And it was like the only, on the half chance that she listens, I don't want her to hear what the activity was, but the there was no competition for it. There was no other offerings for it. And it's a pretty common like experience type of thing here in Texas. So that kind of gets to the root of my problem with this, which is it's like a qualified marketplace. Like they're qualifying all these applicants, right? So it's just going to grow. Like maybe in 3 or 4 years, there's going to be a lot more competition for that experience. But I wasn't able to price check against other services or anything like that, and I ultimately just said no. And if there was more, I probably would have chosen one of them. So
You can
I
look
would
at that
just
bullish or bearish though, because the supply. It seems like the supply is going to come online.
but isn't part of the beauty of Airbnb that anyone can sign up and host? Now
Well,
they've reined it back a little bit, but isn't that kind of what's created like so many different places to stay and so much like diversification in terms of the type of stay, the price of your stay, so on.
they seem to think they can scale all these applicants. We'll see. One thing they talked about is the homes are average rating is like 4.8 stars versus experiences is 4.93. So they seem to think that since they're vetting more, they're going to start out with higher quality and they're not going to have that quality issue that plagued them for years with the kind of playing whack-a-mole with the host. But I don't know exactly how they're going to scale all these applicants because you have to get vetted, I assume, like individually by a person. So that's a lot of employees. I don't know what the cost is gonna be there, but we'll see. It's not gonna move the needle for many years if it does at all. So you really need to be focused from a financial perspective of making investment over the next couple of years on what their path is for growing supply in the marketplace and growing GBV payment volume through the home sharing platform, which I think they have easy steps to do internationally. North America could be slow, but globally, there is a ton of room to take market share.
Speaking of buybacks, because we talked about that for Remitly, Airbnb is turning into a bit of a buyback machine here. I'm pulling this up on Fiscal AI. Last
Yeah,
12
it's
months,
a nice part of the quarter, or it's a nice part of the story.
yeah, last 12 months they have repurchased I think it's like 4.4 billion dollars.
Versus
What's
an
the
$80 billion market cap. Yeah, what should
it's,
be able to do that math.
I can just pull it up here. Buyback yield is currently at almost 6%.
Yeah, wow. That can add. That can be nice. That can be nice.
Could be a
There's some
chance to add some
SBC in
shares
there.
here.
Yeah, it's not. I just wanted a little cheaper to add more. I already have a position, so maybe I'm thinking differently. But what are we at? Price 120. I think I bought more 100 to 110 range. Can maybe quibble on that. It's not expensive. I don't think it's dirt cheap here, but still a high quality business.
All right. Coupang earnings, our
Yeah.
favorite Amazon of type company.
Amazon. Yeah. Well, we just had someone talk about in the chat that they came over here because someone recommended Amit, I think was
Amit, yeah.
Amit, sorry, was talking about our episode on Grab. So people seem to enjoy that one that Ryan did for the research episode, I should say. I appreciate all the kind comments as well on the Oscar Health one from last week. That I think this is the first time we've talked about that post that coming out. So go listen to those two ones if you want more in-depth research, stock report type episodes. But Ryan, were you surprised that Coupang fell after this quarter?
Yeah, a little bit. I think a lot of people just don't want to deal with the capex that's coming as they expand into Taiwan. But I will say, grab my Asian tech stock basket right now would consist of Coupang and Grab. I think those are
Those are the
probably the
two.
two. I don't
Small
actually own
basket.
Grab right now, but I should.
Yeah.
Yeah. Is there any other ones that we've covered that we really like?
I don't know much. Sea Limited. I don't know much. Asia is in general something I don't know much about, as opposed to like Mexico or Chile, Colombia, Argentina stocks. I know at least a little bit, but we know Coupang. Do you want to go through the numbers, Ryan? Product commerce, 26% growth in gross profit year over year. Now, product commerce is their Korea e-commerce marketplace, so that kind of the core. Think about it like Amazon Prime like stuff. 26% growth in gross profit, I think, is quite good. And their product commerce EBITDA margin was at 9%. So they're already close to hitting their long-term goal of 10%. And I think they can easily surpass this figure if they want to. Taiwan is accelerating rapidly, $32.3 billion in trailing revenue. Um, Here's a quote, and then I'll go through some basic valuation work, and then Ryan can talk about what he wants about the quarter. Quote, after ending last year in Q4 with a quarter-over-quarter revenue growth of 23%, referencing Taiwan, this quarter revenues surged 54% quarter over quarter, more than double the pace of revenue growth from just 2 quarters ago. Year over year revenue growth was triple digits in Q2, and we expect that to be even higher in Q3. Now, this is Taiwan, so it seems that the product and marketplace is catching fire. Now, free cash flow and earnings may come down in the short run because they invest so much in Taiwan to catch up with all this demand. But then revenue is going to accelerate, and I think the moat can widen further with cross border inventory and having better stuff on your marketplace. And eventually, free cash flow will recover. Stock seems cheap to me still. EV, enterprise value is about $50 billion. I think there's a path in a couple of years to hitting $5 billion in earnings, especially if you just consider the way they're growing. They can get to $50 billion in revenue somewhat soon, soon meaning a couple of years, and 10% margin on that, $5 billion. I think if they keep this pace up, market cap goes to $100 billion in a couple of years.
It's one of those stocks for me that's actually just so easy to own, where it's yet to get extremely overvalued, which is usually when I end up, well, if it ever happens to me, that's usually when I end up selling a stock, is like it gets an uncomfortable valuation for me and I want to find somewhere else to allocate it. Because Coupang reinvests so much, like you said, there's a path to $5 billion in earnings over the next couple of years, but we're probably not going to see that. We're not going to see that in the free cash flow figure. If Taiwan's performing well, they're going to continue to invest into it. CapEx is going to continue to grow. It's going to hurt free cash flow, but it's like Amazon in basically 2000 through 2010 when they were just ramping CapEx related to fulfillment, and it just built it, like, it obviously expands their moat, but there's never an earnings figure to point to, so it always feels expensive. But really, if you look at it as like peek through earnings, whatever figure you want to use, it's it's going to probably continue to be reasonably priced, and I think they can generate good returns on all that capex that they're deploying. They've done this very well in South Korea. They have a huge advantage now in terms of suppliers as they enter Taiwan, so it's not like they're starting from scratch.
And they have the playbook.
Yeah, they have the playbook as well, and I assume, I guess I don't know Taiwan that well, but I would assume there's a lot more population density, which was a big advantage for them in South Korea, when you look at it relative to, like, Amazon, for example, where there's a lot of costs in the fulfillment side of things. In South Korea, Coupang, I think, was within 7 miles of like 95% of the population or something like that. So it reduces a lot of those fulfillment costs where you're traveling instead of actually delivering packages, and it just leads to more efficiency. So maybe I'm wrong on some of the population density for Taiwan, but I suspect they've got a similar playbook and they went into that market for a reason.
Yeah, I think Amazon's spending a couple $1 billion to increase their speed of delivery in rural areas in the United States, and I bet that it's in Coupang's entire CapEx spend up to this point in South Korea, and they already have faster delivery speeds, so it's, yes, a lot easier for them. Now, it would be technically easier for a competitor to step in, but given the ecosystem they've built of all these products, I'm comfortable with this moat. I think I'm gonna still hold on to the shares.
Bomb Suk Kim, the CEO, I think is one of my, if I had to go kind of top 5 young, hungry founder CEOs, Bong Kim would be up there.
Yeah.
Brian
Uh,
Chesky
uh,
might be up there as well. Zuck
Remitly,
even.
Oppenheimer. He's good.
Yeah. Yeah, I mean, for his business, he's done really well. I don't I think I might put, like, Zuckerberg and Chesky maybe a tier above, but Oppenheimer has done a good job.
Zuckerberg's old, even though he's young. He's been around too long.
I know, but
He's
he's younger
young.
than Chesky.
I know, but he's been around so long that I don't think he counts in that anymore. Do you want to do OpenAI's valuation? There's Nintendo, but it's really not much. They sold a lot of Switch 2s. We'll see what the numbers look like in a couple of quarters financially.
Sure. I'm seeing the price tag you've got here for OpenAI. Where did you see this?
This was a Reuters article. I think it was sourced in a couple different areas. I'd assume it's from the company. Quote, OpenAI is in early stage discussions about a stock sale that would allow employees to cash out and could value the company at about $500 billion, a source familiar with the matter said. Again, when someone says a source familiar with the matter, that's always like from the people that you're referencing. It's someone from OpenAI. Um, they're doing this ahead of an IPO. I guess I would probably sell at that valuation if someone wants to buy my shares. According to the article, they are on track for $20 billion in annual recurring revenue by the year end. My question for you, one, Ryan, is this a reasonable valuation? And do you think they are cash flow positive by year end if they get that number?
No, I don't think they're cash flow positive. I don't think they have any incentive to be cash flow positive. At the moment, they seem to have sort of an unlimited runway of liquidity, and they're probably in spending wars with the other, like Gemini and Anthropic and them. So no, I'm quite confident that they will not be cash flow positive. Not to mention it's capex intensive business, so cash flow for sure. No,
Right. They're raising a lot of money.
yeah, yeah, it's they got to buy a lot of GPUs, and those aren't those aren't cheap. As we saw with pretty much every big tech capex guide this quarter. So now I mean, good for them. They are probably, I assume, the quickest company to ever hit this big of revenue figures. $20
Right.
billion since I think they were founded in what, like 2019?
Or,
Maybe
I mean, they came
2016
out kind
actually.
of out of incubation. Yeah. Pretty quick. Pretty darn quick. And yeah, it's viral product. They're moving quickly. It's fun to track, but I would never own it. Sorry.
Yeah, no, probably not. And if anyone's offering you shares in the private market, ignore those. Please
Yeah.
ignore those.
And
It's
if it's
not,
anyone to our listeners, it's probably or us, it's probably a scam
yeah.
unless you're a really big, like, professional investor. We're
We
getting a lot of Peter Lynch lessons from this episode. One, Portillo's national expansion. There's a lot of lessons from Lynch in that. Second, market share gainers with Remitly. And then third, with here, never invest in the hottest sector. Doesn't end well.
It feels to me, and there are like everything's overvalued, but my portfolio. I think that's like the how everyone approaches markets like this, myself included. But it feels like a lot of the companies I'm looking at are still just like quality is absurdly priced type of thing. Are there
Except
any
Alphabet. Except Alphabet, right?
I guess. I mean, on a free cash flow basis, it's pretty
It's
expensive.
deteriorating. Yeah, gotta hope for that ROI.
Yeah, you gotta hope the GPUs don't appreciate too or depreciate too fast. The Are there any pockets of the market that you think are just neglected right now?
Well, that's a tough question. Not tobacco anymore. That stuff's soaring.
True.
Congrats to everyone that's owned that. What am I looking at? Well, small caps, small caps doing well. We didn't get a chance to talk about this week, but the real brokerage I did a research episode on them. They showed good progress again this quarter. The stock looks cheap. It's trading at a really reasonable price, I think. Yeah, small caps.
Small caps. We do have a
I know that's
comment.
not a sector. It's not a sector, but I
Well,
got
I'll
nothing
take it.
for you.
We have a comment here. I was talking about great founders. He says Anthony Noto, one of the best CEOs. Yeah, I don't believe he's a founder, but he's very heavily incentivized. I believe owns a ton of stock. He's the CEO of SoFi. And I was looking at some numbers, and this kind of reminds me because I think I'm going to sell my Ally position. I own Ally Financial, one of the largest automotive lenders, and for a long time they were just the online bank. Like they were kind of a pioneer in online banking and they were attracting a lot of deposit customers. But in the last year, SoFi has added almost an entire Ally bank in deposit customers just in the last year. They
Not
so
not
I
the entire deposits, but they're
Yes.
starting small and maybe it'll grow over time. Yeah, I agree. SoFi's executed phenomenally well. They're they're doing no complaints. I mean, they're doing quite well.
Yeah, I think SoFi crossed 10 million members and Ally was at like 3 million like customer depositors, and SoFi nearly added 3 million this year. And that is just to say there are so many neo banks right now that are competing on who can provide the highest interest rate, who can, pay a little more for the customer acquisition cost, who can be the most user friendly experience. I just don't like whatever you think of Ally's loan portfolio. I don't think they're going to continue to really be a big market share taker in a world where neobanks are this competitive.
All right. Well, we'll keep updated on that. We're going a little long, so let's get out of here, Ryan. As a disclosure, well, first off, thank you for the people that join in live. We do these 2 p.m. Pacific time, 5 p.m. Eastern time every Thursday. You can watch the replays on YouTube or listen the day after Friday mornings on Spotify, Apple Podcast, wherever you get your podcast. But as a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you for the people that joined us once again. And we'll see you next time.